Hello learners, welcome to Accounting Grade 12. Today in this video we're going to talk about repurchase or buyback of shares. Now let's start with what does repurchase or buyback of shares mean? It simply means that the company is buying back its own shares, for example on the stock exchange. For us to understand this clearly, we need to first know that companies issue shares on the stock exchange so as to raise capital. Now repurchase is the opposite of that. They are now buying back those shares. Hence we call it repurchase or buyback of shares. Now let's analyze some of the reasons why a company would buy back its own shares. Why would a company buy back its own shares? Number one, the reduction of shareholders could result in higher returns for the remaining shareholders. Take a look at this. You used to have many shareholders and they would divide the dividend among them. Now you can have less shareholders after the repurchase and you divide almost the same dividends over those less shareholders. This has the effect of increasing the returns for each of the shareholders that are remaining. Directors may also wish to adjust the debt-equity ratio through the buyback of shares. Now remember the debt-equity ratio from the word debt-equity. Debt simply means money borrowed from other people or financial institutions versus equity. Equity is money raised from shares. In other words, we are trying to see here, we are trying to weigh the two. That is what the debt-equity ratio does. To see for how much of the debt do we have equity. So directors can try to change the debt-equity ratio through buyback of shares. Number three, heirs of a deceased estate might not wish to become shareholders of a company. For example, someone is died and they leave their property to someone else, and part of that property can be shares. You don't want them, which means you don't want to be a shareholder of that company, but these shares have been given to you. You can simply sell back the shares to the company. So in that instance, the company can buy back the shares. Some shareholders are dissatisfied, for example, with the dividend that they are getting, and they may wish to withdraw, which means they no longer want to be a shareholder of the company. They will give up their shares, they will sell their shares. In that instance, the company can buy back the shares. Now in a private company, they don't sell their shares on the stock exchange, which means their shares are not sold to the general public. So if family members own a company and they wish to retain control of that company, they can buy back shares from other shareholders so that they can retain the ownership of the company to themselves. So that's it for the reasons why a company might do a repurchase or buyback of its shares. Now let's go ahead and take a look at the effect of a repurchase on the accounting equation. Remember our accounting equation: assets is equal to owner's equity plus liability. In this instance, a repurchase affects only assets and owner's equity. Why assets? We are repurchasing our shares, which means we use money. So cash is used to buy the shares back, which means one of our assets is going to decrease. Bank is going to decrease. Money is going to decrease because we are buying back the shares. So assets are going to decrease, specifically bank. Owner's equity. Remember, owner's equity represents those amounts contributed by the owners of the company. In this instance, amounts contributed by shareholders. Since we are buying back, owner's equity is going to decrease. Remember, when we issue shares, when we sell shares to the shareholders, when they buy the shares, owner's equity will increase because they are putting money into the business. Now that money is being given back. It means owner's equity will decrease. Take note, there is no effect on liabilities. Why? Because the transaction is concluded and the shares are bought back, and all the money is paid cash, which means there are no liabilities that are created. Now, moving ahead, we want to take a look at the effect of the repurchase of shares in the preparation of financial statements. Let's start with bank. The bank is reduced by the repurchase value paid for the shares. Now, how do we calculate the repurchase value paid for the shares? Simple. Simply the repurchase price per single share multiplied by the number of shares repurchased. This will give us how much the repurchase value is. And what is the effect on the bank? Remember, we are buying back the shares, which means bank is going to be reduced. Bank by nature has a debit balance, which means bank increases when we debit and decreases when we credit. That's why we are saying in this case bank is going to be credited by the repurchase value paid for the shares. Let's look at the next effect. Ordinary share capital. The ordinary share capital is going to be reduced again, in this instance by the number of shares multiplied by the average issue price per share. Take note, the calculation is number of shares times the average issue price per share. So why use the average issue price per share? And what is this average issue price per share, and how do we calculate it? Let's get to that. First, we use the average issue price per share because we are buying back the shares, but the shares that we are buying back, they were bought at different prices from the company or from the stock exchange by the shareholders, and at different times. Hence, we cannot associate these shares with any one particular price. What we are simply doing here is we are using the weighted average price. That is what we are doing. Now, how do we calculate the average issue price per share? The average issue price per share will simply be calculated by using the following. We need to know the number of shares before the repurchase. We also need to know the value of the ordinary share capital account before the repurchase. We will now say the ordinary share capital value divided by the number of shares. Don't worry about these calculations. There is another upcoming lesson where we are going to crunch the numbers. In this lesson we are just sticking to the theory. In the next coming lesson we are going to crunch the numbers. We'll be calculating exactly what we are saying now. Now let's see, what effect does the repurchase have on ordinary share capital? Remember, we said it's going to be reduced. Ordinary share capital has a credit balance. It increases when we credit and it decreases when we debit. Now, since the ordinary share capital is going to be reduced by the value that we have just talked about, it means we are going to debit. We are going to debit the ordinary share capital. That is how it is going to be reduced. The next effect is going to be on retained income. Retained income is going to be reduced by how much? The difference between the reduction in bank and the reduction in the ordinary share capital. The difference between these two values will give us the difference by which the retained income is going to be reduced. Now, why do we have to bring the retained income into this? Remember, these shares that are being repurchased, the income that has been retained in respect of these shares for the past years is this income that we are going to reduce now through the effect on the retained income account. In case some are wondering, what is retained income? I don't understand retained income. Now, remember, retained income, these are profits that are not distributed to shareholders as dividends. These are just kept as a reserve in the company. But in actual fact, they belong to the shareholders, even if they have not been distributed as dividends. Why do they belong to the shareholders? Because the shareholders are the owners of the company, right? So we are simply saying now, since profits had been accumulated and not distributed as dividends for these shares that are being repurchased now that these shares are being repurchased, we also need to cut out that portion so that it goes along with those shares. Retained income has a credit balance, meaning that when retained income increases, we credit. When retained income decreases, we debit. So what effect do we have on the retained income account? We are going to debit the retained income. With which amount? Which amount are we going to use? The amount, as we said earlier, is the difference between the effect on the bank account and the effect on the ordinary share capital account. The effect on the bank is much greater than the effect on the ordinary share capital account. So you get the difference between the two. That is the effect on the retained income account. Now we just want to do a quick recap. Let's recap. What did we talk about in this short lesson? What did we talk about? At the first of the lesson, we talked about defining the repurchase or buyback of shares. The company is simply buying back its own shares. Next, we talked about the reasons why a company would buy back its own shares. I hope you still remember these reasons. Let's just quickly go through just one or two reasons. Remember, we said directors may wish to adjust the debt equity ratio, or the heirs of a deceased estate might not wish to become shareholders. Number 3, we talked about the effect of buyback on the accounting equation. Remember the accounting equation? Assets is equal to owner's equity plus liabilities. And then next, we talked about the effect of repurchase of shares in preparation of financial statements. Here we talked about the effect of the repurchase of shares on the bank account, on the ordinary share capital account, and on retained income. So that's it all for today. Make sure not to miss the next lesson, where we are supposed to be crunching numbers, calculating the figures, and doing the practical work on repurchase. Also make sure not to miss the next and upcoming lessons. Thank you all folks for today. Bye bye.